It's kind of amazing how much trust we just, well, place in financial institutions every day.
Mm-hmm.
Like opening an account, checking investments, even just trying to figure out a transaction. You're basically relying on this huge, unseen system working behind the
It
scenes.
really is foundational. And most people, they never really think about it, but it's this incredibly complex web that, keeps the whole financial system ticking and maybe more importantly for individuals, keeps your information safe.
Exactly. And that's what we're diving into today. We're going deep into the, let's say, often overlooked but absolutely vital world of financial compliance rules.
Yeah, the nitty-gritty.
Our mission here is basically to unpack the key regulations that firms, especially broker-dealers, have to follow. We'll look at how they spot things like money laundering, how they guard your personal data, and make sure they're communicating clearly with you, all based on the expert sources we've got.
And I think what you'll find is just how detailed these rules get. It's way beyond just, keeping good records. We're talking about active systems to prevent serious crime and protect privacy. Some surprising stuff in there about what firms can and, maybe more importantly, can't do.
Okay, let's jump right in then. First big area, fighting illicit funds, anti-money laundering, or AML. Every broker-dealer has to have an AML compliance program, right? No choice.
No choice at all. It's absolutely mandatory. And these programs have specific minimum parts.
Like what? What are the essentials?
Well, first, clear written policies and procedures. These have to spell out how they'll detect and then report suspicious transactions. They also need a dedicated compliance officer.
Okay, someone in charge. Do they need special registration, like with FINRA?
Interestingly, no. The compliance officer doesn't specifically need to be FINRA registered for this role.
Yeah.
They do need to be appointed. Then there's ongoing employee training. You have to keep everyone sharp.
Makes sense. And how do they know the program actually works? Is there like a checkup?
There is, and it's crucial, an independent audit function. Our sources actually call it a stress test, which I think is a great term. It's meant to really push the system and see if it holds up.
A stress test, I like that.
Yeah.
And this whole thing needs to be written down and signed off by the top brass.
Exactly. Written down and approved by senior management. Documentation is key.
How often do they have to run this stress test?
Yeah.
Annually.
Annually, yes. That's the standard. The only exception is for firms that don't handle customer accounts or transactions at all. Think proprietary trading firms, just trading their own money.
Oh, okay. So if it's just their own capital.
Right. For them, it's biennial, so every 2 years on a calendar year basis. But for everyone else dealing with customer money, it's every single year.
Got it. Okay, related to AML is this idea of knowing your customer, the Customer Identification Program, or CIP. What's the main goal there?
It's pretty straightforward, but critical. Verify the identity of anybody opening an account. It's step one in preventing bad actors from accessing the financial system.
So what info do they absolutely need to get from you?
The minimums are your name, date of birth for individuals, a physical address like your home address, or the main business address for a company and an ID number.
Like a social security number.
Right. For U.S. folks, usually SSN or an employer ID number, EIN. For non-U.S. citizens, it could be a taxpayer ID, passport number and country, alien ID card, or some other government ID with a photo.
And they don't just take your word for it, presumably. How do they actually check?
Oh, definitely not. They have to verify it. They can use documentary methods, looking at your driver's license or passport.
Okay.
Or they can use non-documentary methods. That might mean checking databases, maybe calling other banks you use, or using consumer reporting agencies.
What if someone's applied for, say, a taxpayer ID but hasn't got it yet? Is there a workaround?
There is, actually. There's a temporary exception if you've applied but are waiting. The firm just needs to keep a copy of your application on file.
And how long do they hang on to this identity verification stuff?
This is important. They have to keep those records for 5 years after you close the account, not just while it's open.
5 years after closing. Wow. That helps build a long trail.
Exactly. It's about having that historical data if investigators need to look back later. And you asked about seriousness earlier. The penalties for AML violations, they're huge.
How huge?
Potentially up to 20 years in prison. And fines can be up to $500,000 per transaction, or even twice the amount of money involved, whichever is bigger.
20 years.
Hmm.
Okay, that's serious. Our sources mentioned something called willful blindness. Can you break that down? It sounds important.
It's incredibly important. Willful blindness basically means you can be held responsible even if you didn't directly know about or participate in the money laundering.
How does that work?
If the situation suggests you should have known something was wrong, like if there were obvious red flags and you deliberately chose to ignore them or look the other way, that's willful blindness. You can't just plead ignorance if you intentionally avoided finding out the truth.
So turning a blind eye is no excuse. That puts a lot of responsibility on individuals within the firm.
Absolutely. It forces people to be vigilant.
Okay. Besides just suspicious activity, are there specific people or groups that firms are totally banned from doing business with?
Yes, definitely. That's where the specially designated nationals and blocked persons list comes in the SDN list.
Who maintains that?
It's maintained by OFAC, the Office of Foreign Assets Control, part of the Treasury Department. This list names known or suspected terrorists, criminals, and entities from certain sanctioned countries like Syria or Iran, for example.
And the rule is simple. No business.
Absolutely zero business. Firms must not deal with anyone on that list, period.
What if they find out later? Like an existing client ends up on the list.
Immediate action required. They must block all transactions right away and report it to federal law enforcement, no hesitation.
Wow.
And there's also extra scrutiny, special due diligence required for things like private banking accounts for foreign nationals, plus a ban on correspondent accounts for foreign shell banks.
Shell banks? You mean banks with no actual physical office?
Exactly. Banks that exist only on paper. They're seen as a high risk for money laundering, so U.S. firms can't provide services to them. It's all about closing loopholes.
Okay, so that covers the big fight against illicit funds. Let's shift gears a bit to something maybe more personal for listeners, protecting your individual financial data. That brings us to SEC Regulation SP.
Right. Regulation SP. It came out of the Gramm-Leach-Bliley Act back in 1999, and its main job is protecting the privacy of consumer financial information.
What does it require firms to do at its core?
Three main things. 1, set up clear privacy policies. 2, tell customers what those policies are. And 3, give customers the right to opt out of having their information shared with certain third parties, specifically unaffiliated ones.
Unaffiliated meaning companies not related to the firm.
Exactly. And this applies pretty broadly. Broker-dealers, investment companies, SEC-registered investment advisors, they all have to comply.
It's not just about who they share it with, but also how they keep it safe, isn't it?
Absolutely. Firms need policies and procedures to physically protect your records and information. They have to ensure security, confidentiality, protect against threats, and, crucially, prevent unauthorized access that could harm you.
What kind of info are we talking about? Everything.
It specifically focuses on non-public personal information. So stuff you provide or stuff derived from that, like your account numbers, transaction history, that sort of thing.
What's not covered then?
What's not restricted is publicly available information. Think information from public government records or widely distributed media, stuff that's legally out there for anyone to find. Reg SP is about protecting the private stuff.
Okay, that makes sense. And this leads to the privacy notices we all get. What's their purpose, and when do you get them?
The notice has to describe the firm's privacy practices, what info they collect, and who they might share it with, both affiliated and unaffiliated third parties. The timing's important, though.
How so?
Well, for consumers, someone just shopping around, maybe hasn't opened an account yet. They only need to get the notice before the firm shares any non-public info with unaffiliated third parties. If the firm doesn't plan to share, no notice is needed at that stage.
But for actual customers, people with an ongoing relationship.
For customers, you get the notice when you first establish the relationship, like opening the account, and then you get an updated one every year after that.
An annual reminder. And that notice has to tell you about opting out of sharing with those unaffiliated companies.
Yes, it has to clearly explain your right to opt out and provide a reasonable way to do it.
What counts as reasonable and what doesn't?
Reasonable could be, clicking a link online, maybe a toll-free number. What's not considered reasonable, according to our sources, is making you write and mail a physical letter. It should be easy for you to opt out.
Good to know. Okay, sticking with data protection identity theft, there's the FTC's red flags rule. What's that about?
Right, the red flags rule. It requires many financial institutions, banks, broker-dealers to create and actually implement a written identity theft prevention program.
And the goal?
To spot red flags, suspicious activities early, so they can prevent someone from stealing a client's assets. The program needs policies for what to do if they suspect or detect identity theft, and it gets referenced in their main supervisory procedures.
This ties into an interesting point from our sources. Can a firm that's acting as a trustee for a company use that company's shareholder list to find new clients, like cold calling them?
Ah, that's a definite no, generally speaking. Industry rules prohibit using that kind of privileged information for solicitation or prospecting.
Unless?
The only exception is if the corporation itself specifically directs the firm to do so, and it's for the corporation's benefit. Otherwise, using that shareholder list for the firm's own marketing, that's off limits. It's a key privacy protection for shareholders.
Makes sense. Okay, moving on to keeping clients in the loop. Notifications and communications. How often should you expect account statements?
At a minimum, broker-dealers have to send them quarterly. But realistically, if you have any activity in your account, trades, dividends, anything, you'll probably get one monthly.
And what absolutely has to be on that statement?
It needs to show all your security positions, any cash balances, and all the activity since the last statement: buys, sells, interest, fees, dividends, money moved in or out, securities delivered, the works. Full transparency.
And then for every single trade, there's a confirmation statement, right?
Yes, the SEC requires a detailed confirmation for every purchase or sale. It has to be sent at or before the completion of the transaction, which usually means the settlement date.
What key details are on that confirmation,
Yeah,
besides the obvious, like the stock and price?
lots of important stuff. Identity and price of the security, number of shares or amount, the date and time of the trade, or an offer to provide it. Crucially, it shows the capacity the broker acted in.
Capacity, what does that mean?
It means whether they acted as your agent, just handling your order, or as a principal, selling to you from their own inventory or buying from you for it, or sometimes as agent for both sides in a cross trade. It's vital for understanding potential conflicts.
Ah, okay. And commissions or markups?
Yes, those have to be disclosed, dollar amount and sometimes percentage. For bonds, yield information. Also, if a security is callable. And of course, the settlement date.
Who gets this confirmation? Always the customer, even if someone else manages the account.
Always the customer. That's a key point. Even if a registered representative has discretion over your account, the confirmation must go to you. It can go to a third party, like your investment advisor, but only if you've given written permission. You, the account owner, need the direct record.
Okay. What about holding mail? If you're traveling, can the firm just hang on to your statements?
They can, but only under very strict conditions. You have to give them written instructions specifying the time period.
And there are limits on that time.
Yes. If it's going to be longer than 3 consecutive months, your instructions must include a valid reason, and simply saying it's for convenience doesn't count as valid.
So I'll be out of the country is okay, but I just don't want to deal with mail.
Pretty much, yes. The firm also has to tell you about alternative ways to monitor your account, like online access, and they need to check in periodically to make sure your instructions still apply. Plus, they have to safeguard the mail itself.
Lots of rules around that. Finally, on records. Electronic delivery. Statements, confirms, tax forms, can they all be sent electronically instead of paper?
Absolutely. Electronic delivery is perfectly fine for all those records. And interestingly, SEC rules say that just providing you access to the records online counts as delivery.
So if they put it on their website for you, that meets the requirement.
Generally, yes. If you choose electronic, they don't necessarily need to send paper to. Although some firms might charge a small fee if you specifically request paper copies, especially for confirmations.
Okay, let's shift to the rules of engagement, how firms actually talk to you. Fiduciary has different categories for communications, right? This sounds like it could get complicated.
It can be a bit tricky, yeah. Fiduciary breaks it down into 3 main types, understanding which is key for compliance.
What's the first one?
First is correspondence. This is defined pretty tightly. Any written or electronic message sent to 25 or fewer retail investors within any 30 calendar day period.
So small scale, like a personal email or a letter.
Exactly. Physical letters, texts, emails to just a few clients. That's correspondence.
Okay, what's next?
Next is institutional communications. This is stuff sent only to institutional investors. It doesn't include internal memos within the firm, just communications going out to institutions.
And who counts as an institutional investor? Is it just massive funds?
It's actually a broader list than you might think. Of course, it includes banks, insurance companies, registered investment companies, registered investment advisors.
The usual suspects.
Right, but also government entities. Big employee benefit plans like 403Bs or 457s if they have at least 100 participants. Also other broker-dealers and their reps. And here's a key one. Individuals or entities with total assets of at least $50 million.
$50 million. So a very wealthy person can be treated as an institution for communication rules.
Correct. And anyone acting solely on behalf of these institutions, it's quite a wide net.
Interesting. What if one of these institutions forwards the communication to a regular retail client?
Ah, that's a compliance headache. Firms have to try and prevent that, maybe with a disclaimer like, for institutional use only. But if the firm finds out an institution is passing it along to retail investors, then any future communications sent to that specific institution have to be treated as retail communications. The classification changes based on behavior.
Okay, which brings us to the third and probably biggest category, retail communications. What's that?
This is the catch-all for broad distribution. It's any written or electronic communication that's distributed or made available to more than 25 retail investors within any 30-day period.
So anything aimed at a wider audience.
Pretty much. Think advertising TV, radio, billboards, magazines, newspapers. Also, websites accessible to the public, online forums like chat rooms or static blogs if retail investors can see them, even telemarketing scripts.
Wow, sales literature too.
Yes, sales literature falls under this if it goes to more than 25 retail investors. Even reprints of articles, if sent out widely. It's the broadest category with the strictest rules because it reaches the most people.
What about everyday things like email or instant messaging? They could be any of the three, couldn't they?
Exactly. They're chameleons. An email could be correspondence to 10 retail clients, institutional to 50 advisors, or retail, a blast to 100 retail clients. It all depends on the recipient list, who gets it, and how many.
And social media, you hear about reps getting into trouble there?
Yeah, social media is tricky. Fenner often views posts on public sites as public appearances, which have their own rules. But more broadly, many firms just restrict or heavily monitor reps using social media for business communication because it's so hard to supervise effectively and ensure all those posts meet the communication rules we've been talking about. It's a compliance minefield.
Okay, so we have these three categories. Who needs to approve this stuff before it goes out? Does it vary?
It definitely varies. For correspondence and institutional communications, they need to be supervised and reviewed by the firm, but they generally don't need a principal signature before they're sent.
But for retail communications, the ones going to more than 25 people.
That's different. Retail communications must be approved by a qualified principal, basically, a supervisor before they go out, unless there's a specific exception. And for certain types, like communications about options or mutual funds, they often need to be filed with FINRA as well. Much higher level of scrutiny.
That makes sense, given the wider audience. Wow, what a journey through these rules. We've really covered a lot from fighting money laundering, protecting your data with Reg SP and red flags, to making sure you get clear statements and confirmations, and finally navigating these different communication lanes.
It's a lot, but you can see the common thread, right? All these complex regulations, deep down, they're about protecting you, the investor, the consumer. They're meant to build that trust we talked about at the start, keep things secure, and make sure the information you get is fair and clear.
Absolutely. It really puts things in perspective. So here's something to think about. Given how incredibly detailed and strict these rules are, especially around how financial firms can communicate, what does that tell us about the financial information we just stumble across elsewhere? Online, maybe from less regulated sources, or even just talking to people. How could you use this understanding of the required standards to be, a sharper consumer of financial information? Maybe spot those subtle signs that show a firm is taking these rules seriously. Or maybe spot a potential red flag when something just doesn't seem quite right. Definitely something to mull over.